Today's episode of Hidden Forces is made possible by listeners like you. For more information about this week's episode or for easy access to related programming, visit our website at hiddenforces.io and subscribe to our free email list. If you listen to the show on your Apple Podcast app, remember, you can give us a review. Each review helps more people find the show and join our amazing community. And with that, please enjoy this week's episode. What's up, everybody? What you're about to hear today is only part of an over 2-hour-long conversation that I recorded last week with investor and self-ascribed dilettante farmer Ben Hunt. Ben has a very interesting career arc. He got his Ph.D. in political science from Harvard, he's co-founded multiple tech companies, and he managed his own billion-dollar hedge fund. He now spends most of his time farming, which we'll get into, and writing what has become an extremely popular website and newsletter called Epsilon Theory, where he focuses on trying to understand the narratives that are being created, refined, and repeated in the media and social media, and which drive so much of our perception of the world and our behavior as investors. He's done 2 other interviews, one with Grant Williams for Real Vision in 2018, and the other with Patrick O'Shaughnessy, also from last year. Both were excellent and I think complementary to one another. And I didn't want to really repeat much of what was discussed in those, and I think we accomplished that. The main themes from Ben's work that we focused on were his use of the 3-body problem in physics and how it relates to markets, and the illusion of pattern and predictive power in historical data, and also the power of narrative, and how he tries through his work to not only understand what people are saying and thinking about the world, but how the media and society shapes how we think about the world. And in that vein, we discuss a number of contemporary market phenomena, including a really unique, thoughtful, and I think illuminating conversation on Bitcoin, its culture, the narrative of Bitcoin, how that narrative emerged, how it's evolved, and how it informs the trajectory of cryptocurrency prices. Like I said, this is an over 2-hour-long conversation, and much of the conversation on crypto continues well into the overtime segment. I've also put together a series of time codes in the description for anyone who wants to skip ahead. Check that out. And with that, please enjoy my conversation with Dr. Ben Hunt.
It's like you went to the wall and you flipped a switch in March of 2009. We'd made good money in 05, 06, 07, and we killed it in 08. Just killed it in 08. Running net long the whole year and up 20-something%. And I've thought about this a lot since then, as you can imagine. And, people are saying, oh man, that's great. How'd you do it? And the real question people should be asking is that given your positions and your views in 2008, why weren't you up 50%? Right? So the question is not, oh, how'd you do it to be up 20-something%? The better question is, why weren't you up a lot more? And the answer to that question is that none of us expected the debacle that was 2008 to occur. And those of us who did not come from Wall Street, who had an outsider's perspective, were able to stick with it pretty well, right? But not to the point of fully either understanding or taking advantage of that situation we were in. So in March of 2009, for all of us, it was like you went to the wall and you flipped a switch on our returns. They flatlined. It's not that we lost money for clients. In fact, I'm a hedge fund. I never lost money for clients, and which is I'm really proud of that. One of the reasons I never lost money for clients is that I gave all the money back at the end of 2011, which, my wife, I don't think still has actually forgiven me for, because that's a big lifestyle decision when you give back close to $1 billion. But it wasn't just an issue of intellectual honesty, right? It was an issue of playing what I like to call the meta game, the big picture game. Because when it's not working, when your strategy for making alpha money, which is what hedge fund managers are for, right? When it's not working, to play the longer term game, and in finance, it's a long-term game. You're playing the long game. You should give back the money, right? It was the smartest thing actually I've ever done, because now the investor I had there, they love me. They're
the ones reading your newsletters, among others.
Reading the newsletter, exactly right. And they're there for me to do something else in the future. But it's so hard in this business that we're in, and this gets us into a broader discussion about other meta games in finance, whether it's around Bitcoin, whether it's around crypto more generally, whether it's around active management more generally, where what you end up doing is you end up playing out a string. So most active managers today, their assets are in, if not free fall, at least very consistent decline. Listen, I get this, because still, even to this day, the incomes that are possible for managing other people's money are...
You're saying AUM,
exactly.
AUM is down.
Not just down, but actually at a terminal rate of decline, right? But you still play out the string. And I get it, because the lifestyle is so remunerative that it's very hard to try to step back and say, okay, well, what does work, or where am I going personally for my career and for what I want to accomplish for my family and for my pack going forward. So it's very difficult to step back. It's very difficult to give it up. But I think in these days, and these are days of enormous upheaval, particularly in the money management world, it's incumbent on all of us to try to step back and think about what our larger game is.
What made you decide in 2011 specifically to give it back? Was it because just that was the amount of wear and tear that you could bear 3 years after 2008?
Yeah. So when you're managing other people's money, if you're doing it appropriately, which what I mean is it is a full-time commitment, right? And that means that you don't have the luxury of stepping back and figuring out how to be right. It's like, there's a famous scene in Goodfellas, right, where they're talking about the dynamics of the mob, right, which is, pay me my effing money, right? Always pay me my effing money.
You're talking about when Jimmy was choking Maury and his wig came off?
Exactly. Pay me my effing money. And that is the dynamic when you're managing other people's money. It's not something to be a dilettante with. You have to make money, not be right. And there are points of time where what you're doing, your stripes as a tiger, what you've been trained to do, it's just not working. And this has been the case for anyone who's making discretionary evaluations on a fundamental basis, whether that's the fundamentals of economies, a macro perspective, whether it's the fundamentals of companies, a micro perspective. It empirically has not worked since March of 2009. So we're talking about, more than a decade now.
Especially 2012. No?
Well, 2012 was a bizarro year. They've all been bizarro years. It's been an enormously consistent lifting of
What I mean is there
boats.
was still some moderate amount of volatility in those first 3 years. Is it unfair to say that after the summer of 2012, the outperformance of beta really became the dominant trend?
Honest to God, it started in May of 2009. And what I mean by that is that in March of 2009, you got a very sharp rally off the all-time lows. Right, so the S&P 500 hit like 666, the mark of the devil, right, in early March of 2009, and you had a rally, off those. I got that rally. I understood that. I didn't catch all of it, but I caught some of it, right? And then the market went back down. People forget this in April of 2009, and then in May of 2009 you had a sharp rally. That was a crap rally. So the stocks that went up in May of 2009 were the crappiest stocks imaginable. It wasn't like March of 2009 where everything went up, yes, but it was quality that worked in March of 2009. May of 2009, and then there were, every 4 or 5 months you'd have another crap rally. And that's what really, I think, turned active investing on its ear. At first, nobody wanted to believe it. It was like, okay, we've seen this movie before. It's ephemeral, right? You're going to have a crap rally occasionally. Quality will still out. But you're right, though, by 2012, right, you had a bad year for most active managers in 2011 because you had a significant European downturn, hit the U.S. markets, came back by the end of the year, but most active managers were down for 2011. 2012, that was the turning point, not in the, I'll call it the balance of crap rallies versus, quality, but it was the realization, for me at least, that, something else is really going on here. Because in the summer of 2012, that was the summer of Mario Draghi and the Euro crisis, right? And so that was the summer of Mario Draghi first in a conference in London, and then subsequently first week in August with an ECB conference of the words, whatever it takes, and the words of outright monetary transactions, the OMT program, a totally mythical program, right? But it was just words, but it changed everything. And I remember so vividly the summer of 2012, I had a large short position built up on European financials because, by God, I'd seen this movie before. I know how this plays out. I was going to make just a shit ton of money. And, when Draghi had his press conference, the ECB, that first week in August, that day of the press conferences, I made an enormous amount of money. It was the best day I've ever had, frankly. The next 2 days were the worst 2 days I ever had. And what I remember about those days is that in the morning, the online headline of the FT, the Financial Times, was Draghi's blunder. Because this was the press conference where he had to put some meat behind his whatever it takes statement from 2 weeks prior in London. And so he had to actually say, well, what do I mean, whatever it takes? And he made up this thing called OMT, outright monetary transactions. Well,
I miss those. I miss all those different facilities that they came up with.
Exactly.
It was a lot of fun.
But it was just pure words. By that afternoon, the online FT headline had changed, and it was no longer Draghi's blunder. It was Draghi's bold move.
Amazing.
I'll never forget that, right? It was that change in narrative. It got picked up in the U.S. press. I was watching CNBC during the day. European markets had closed at 11:30 or something like that. And from 11:30 on, the markets rallied, the U.S. markets rallied. And I remember thinking to myself, I wonder how this turns out, even though I'd had the best day ever, right? And the answer was I got my teeth kicked in the next 2 days because you had an enormous rally. I can't even describe it as a crap rally, right, where it was the distressed companies doing particularly well. It was a lifting of markets based on the narrative, based on the words of what we call in game theory a missionary, where Mario Draghi was shaking his finger at us and telling us not just a fact, but he was telling us how to think about facts in the world. And that's such a powerful trick, if you can pull it off, right? That, we think about people in the news telling us a piece of information. That's child's play, right? That's telling you what the unemployment rate is. The real trick is to tell you how to think about the unemployment rate, right? How to think about the role of the ECB. And that is what struck me so hard in the summer of 2012. And it was like, okay, I've given all the money back. Now I've got to step back from any sort of investing, and I got to figure it out. Because it finally gave form, let's say, to the fact that I'd been flatlining on performance since March of 2009. Now I got the glimmer of, okay, I see what's going on now. It's the use of words and narratives. There are no fundamentals for markets now. And it took me about 2 years. So I started writing Epsilon Theory, really kicked it off in the summer of 2013, sent it about the first notes to about 100 friends, colleagues, and it struck a chord. So we've got close to, about 100,000 people now.
That's a lot of people for this type of material.
It is, and frankly, it's the best mailing list in the world. I mean, we play a game where, name an institution, and there's someone there at whatever institution anywhere in the world who gets these notes. That's not about me, right? What it's about is that what I'm describing is affecting all of us who are professionals in markets, and it has truly changed the water in which we swim.
It also, so many thoughts came up listening to you talk. One of them obviously is that what you're describing is also a community, and there's got to be something really gratifying about being at the center of that table.
Changed my life.
Yeah, and so that leads to a larger thing that I'd love to explore a bit later, which is I imagine your life is more fulfilling now than it's ever been. It sure seems like it.
Demetri, I used to get up at 3 a.m. in the morning with a knot in my stomach because I had to get up in time to go, prepare for the open of the European markets, right? And today, I'll wake up at 3 a.m. and it's not with a pit in my stomach. It's that, oh my God, I've had an idea and I've got to write it down to myself.
So exciting. Yeah,
for what I can share. That plus exactly what you said, the notion of community, the realization, I started writing, I was in a pretty dark place, frankly, because, I'd had my teeth kicked in by markets. I'd given up $1 billion hedge fund because I'm trying to figure something out. I mean, what the fuck, right? And so it was enormously, frankly, it gives me hope about everything to understand that there are, not just hundreds, not just thousands, but tens of thousands of people like us, right, who are just trying to figure this out.
So I want to get into that, but I want to create some structure for our listeners who aren't familiar with your work. Because some are going to be. It looks like you did a spout of interviews in 2018. You did one with Grant Williams, of course. Everything Grant does is beautiful. And it was a beautiful conversation recorded at your farm house. You call yourself a dilettante farmer.
Oh, I am. Green Acres, that's me.
Well, even Thoreau was not that far from town.
This is true.
So you're in good company again. Let's begin first with a paper you wrote. When did you write The Three-Body Problem? Was that 2015? 2016? 2016. Yep. I want to begin with that because it seems to me that there are two main components to your work, or things that interest me perhaps, and we can explore more. One is the use of the three-body problem as a metaphor, or maybe not even a metaphor really, but as a framework for thinking about the impact that central banks have had in monetary easing and monetary policy has had, and forward guidance and all this stuff has had on financial markets and investing and all the stuff that we were just talking about.
Yep.
And then the other component is this narrative, which is what I think is the most interesting and more unique to your work, I think, than even that. Let's begin first with the three-body problem.
Sure.
What is the three-body problem?
Well, the three-body problem is a question in physics that was answered by Henri Poincaré, the French mathematician in the late 1800s. And it's a classic problem with an interesting answer. And the problem is, all right, imagine you're in outer space, right? And you've got 3 planets or whatever spinning around. You know everything about these 3 objects. You know their mass, you know the laws of gravity, you know their velocity, you know their exact position. Tell me now, where these 3 bodies will be located at some time t in the future, right? What is the formula for calculating the position of these 3 objects about which you know everything? Right? This is not some problem of uncertainty where we're trying to guess something. I know, physically speaking, everything there is to know about these 3 bodies spinning in space. And what Poincaré proved in the late 1800s is, and this is so powerful, there is no algorithm. There is no, in the term of art, closed form solution for predicting where those 3 objects are going to be. Now, obviously you can calculate where they're going to be a second from now.
It's an issue of computational complexity.
Well,
as time increases, the computational overload becomes...
Well, that's right. So that's exactly right? But it is possible to calculate the future. It is not possible to predict the future. That's such a hard statement for a human, particularly any human who's been involved in markets, to wrap their heads around.
Yeah, what do you mean exactly?
There's no formula. There's no formula by which I can plug in all the information I know about those 3 objects. There is no formula that I can plug in and will give me the answer. There's no closed form solution, right? There is no algorithm. And that's such a hard thing for us to wrap our heads around, particularly if you're involved in markets, because what all of us, what I like to call coyotes, problem solvers, smart guys who are, trying to make some money and trying to figure out these questions, we all get into markets because we're trying to identify the pattern, right? And so traders do it, I'll say instinctively, but, fundamental managers, everyone who's involved in markets, and this is what humans do, we're good pattern identifiers.
Even if they're not there.
This is the thing. This is exactly the thing. And what Poincaré proved is that when you've got these 3 objects floating around in space, right, there is no predictable pattern. And any pattern you think you see, you're wrong. You're wrong. And this is something that all of us humans do, particularly us clever coyotes who are in markets. We see patterns all the time. We ascribe patterning to events. And I know it's hard to accept, but the mathematical proof is that it's not true. It does not exist. And so what we end up doing is that we've ascribed these, I call it laws to markets, that when we get a new gravitational body that's introduced, for example, central banks buying trillions, that's trillions with a T, worth of gravity, of balance sheets, of financial assets, it then creates movement, positioning of prices, of assets, of anything you want to name in financial markets, where there is no pattern. It requires, and this is so hard for people to, for me as well, right? It's so hard for me.
Well, can I ask you something? Just want
to be profoundly agnostic.
Clarify something.
Sure.
We'll get into that also. If you were to close this data set, you could derive patterns that would be meaningful. But as long as the data set's open, what I mean is that any pattern you derive is backwards looking. The entire set's got to be closed. The problem is that this is an open data set, right?
So the mystery, and it really is this profound mystery, is that no amount of historical data on the three-body problem will give you the answer for T plus 20, right?
But it's because it's infinite. In other words, it's ongoing. I just mean that...
Correct.
I understand your point exactly. I mean, I agree with it. I just make the point that because this is, you cannot make forward predictions looking at historical data sets.
That's right. So the boilerplate that we see on all of our, investment products, is required is, past performance is no guarantee of future performance, right? And what Poincaré was saying was, well, that's not just legalese, that is actually the law, right? Yeah. That's the law of nature. And so what is possible, though, and this is, again, something that's hard for humans to wrap their heads around, is that it is possible to calculate, not predict, but to calculate the position of each object in some, short time in the future, and then use more processing power to calculate the position a little bit farther in the future. So it's possible to simulate position, but that's very different, incredibly different, from having a formula that predicts it. And what I find frustrating about, I'll call it the anthropomorphization, to use a $10 phrase, of the way we use computing power, is that we use our computing power today in an anthropomorphic way, in a human way, to try to find these formulas and these algorithms, when what we should be using computing power for is not to predict, but essentially to observe, to simulate, to use, I'll call it an atomic model for understanding the future as opposed to predicting the future. The most powerful computers in the world today are used for not predicting the outcomes of nuclear weapon testing, but simulating them, right? And that's why it takes a supercomputer to try to test the output in a computer of an atomic bomb blast, right? So our nuclear blast. So we don't actually fire off nukes anymore. We simulate them in a supercomputer. And we're not doing this by applying some algorithm. We're applying it by modeling the behavior of each atom of fissile or fusible, material, right? Which is why it takes a supercomputer. So it's
going to be different every time.
It's going to be different every time, depending on, and gets a little bit into the chaotic situation in that minutest change in the starting conditions will have increasingly enormous changes down the road in the simulation. Right, and the truth of the matter. So it's a very non-human way of looking at the world, but it's a way that all of us need to start getting used to, right? Because this is the power that the utility availability of computing power makes these sorts of calculations possible using AWS or whatever, and that changes everything.
So that's Henri Poincaré's interpretation in the realm of physics.
Yes.
How does that apply to the social sciences and to central banking where you've applied this model?
Well, first of all, there's a wonderful science fiction trilogy by, and I'm going to butcher the pronunciation, Cixin Liu. He's a Chinese author, won the Hugo Award for this trilogy, which is The Three-Body Problem. It's a science fiction book, right? It's taking directly from the Poincaré, physics experiment, trying to imagine, well, what would it be like if you had humans actually living in a three-body system, right? It's an amazing work of fiction. It's just one of the best books I've ever read. And so the application of this, right, is not just when we're thinking about a physics system like Poincaré was proving this, but it also impacts social systems, whether it's in fiction or in reality. And Cixin Liu wrote this amazing trilogy, a fictional application of the three-body system. What I think we're seeing in markets today, and this gets back to my point about how since March of 2009, any notion of quality, any notion of differentiation of, I like this company and I don't like that company on some basis, or I like this macro environment better than macro environment, that has failed. It has empirically failed. So why is that? And is this a mean reverting phenomenon? Because the value investor will say, well, give it time and my style will come back. And what the three-body problem teaches us is that actually no. Actually no. That these are not mean reverting systems, right? These are profoundly unpredictable systems. And I'll use another analogy, in the, Game of Thrones, winter is coming and winter is here. Their seasons are based on a three-body problem where it's not predictable how long winter will last, right? Winter may last 3 months. Winter may last 30 years, right? That's what the three-body problem teaches us about any sort of social system of which markets are one. Value has not worked for a decade. It is not a mean reverting phenomenon. It is entirely possible that value will not work for another 4 decades, right? This is what I mean by requiring profound agnosticism. It is not enough to say, oh, my style will come back in favor. It has to, right? It doesn't have to. When you change the system by introducing, in this case, central banks buying trillions of dollars worth of securities, it creates a force of gravity which changes the trajectory permanently, so that your analysis that's based on the last 40 or 50 years of measurements has zero validity. Not just, it has less validity. It actually has zero validity and requires, again, what I call this process of profound agnosticism, which is one of the hardest things for humans to manage.
How new is this way of thinking? Not this most recent, what we're describing here, this profound agnosticism or this fact that we're living in an unpredictable circumstances, but rather that the world is predictable, that we can look at historical data and draw
That's a great question.
Covariant relationships
Yep.
and predict the future based on that data set. How new is that?
So I'll say this notion that social systems are in effect a clockwork, a machine. That's most famously Ray Dalio of Bridgewater's. That's his metaphor. Mm-hmm. He talks about the economic machine, which is a wonderful metaphor. And Dalio does phenomenal work. I mean, I don't need to say that. I mean, he's built the largest hedge fund in the world, and with a.
No, I understand what you're saying, though. I hear where you're going with that. It's not deterministic.
That's right. But it was the late 19th century where the model of a machine, it comes off of the Industrial Revolution, and it starts in the UK, where you start with metaphors and allegories, but then becomes much more pronounced in the sense that society is described as a machine.
Well, it's also fascinating to interject here, and then please continue. I would love to talk to you about this. Maybe we can put a pin into it.
Yeah.
Just how impactful technology is in driving the adoption of language and metaphor.
So right.
Yeah, but continue.
So that was the first, I'll call it, inflection point. And you see it really coming out of London and the UK with describing society in machine-like terms. The next big inflection point was after World War II, coming out of the United States. I think both you and I studied political science,
mm-hmm.
right, in college. Well, just that phrase, political science,
mm-hmm.
right? It's a very American thing. It started in Princeton.
It's very pretentious. If you think about it.
Yes.
I mean, we're used to it, right? But it really is pretentious to call it a science.
We are so used to it. And this is what I mean. It becomes the water in which we swim. But it really started at Princeton. It started in the 30s, I think, at Princeton. But where this whole notion of thinking about I'll call it the scientificization of social studies really gets kicked off, again, in the U.S. after World War II. So the whole notion of finance and what it means to be an investor really changes after World War II. The social dynamic that goes along with this is the extension of Wall Street to Main Street. Mm-hmm. So this is when Merrill Lynch, in particular, the Thundering Herd, opens up their branches in Main Street all over the country. Then there's a transformation after World War II and I'll call it the deification of science, to say that all of these things, all these social behaviors are predictable, that there is an algorithm for us to understand, and that past performance is indicative of the future. It's so at odds, and this is something that I find so striking, that when you read the memoirs, when you read the histories of the lions of Wall Street before World War II, the Andrew Carnegies, the
Jay Gould,
the Vanderbilt, the Commodore, right? They're not talking about free cash flow models, right? There's no discussion of fundamentals.
Carnegie said, put all your eggs in one basket and watch the basket.
Watch the basket, understand the story.
No diversification.
No, absolutely. And look, is diversification and portfolio theory, is it true? Is it right? Of course it is. The math is not wrong any more than the Gaussian copula, which, wrecked the world with mortgage-backed securities, was wrong. Any more that the code that underlies Bitcoin and crypto is wrong. It's not. The math is right. In the same way that Poincaré's math is correct. What changes is our social meaning that we attach to this.
But also it changes when everyone's doing it. Diversification along a particular systemic trading strategy means one thing when you're the only one using it versus when the entire market is chasing that same beta.
Well, it does. And it
brings us back to the point about social systems and complexity.
A social system, feedback, and the intentional desires of, I like to call it the nudging state, right? The clear goal, and this is intentional, right, of political actors, economic actors since the crisis of 2008, the near-death experience of the system, which we can talk about, right?
The near-death experience.
It was a near-death. I mean,
it was cardiac arrest for sure.
It was. We were there. I mean, we can talk about our memories of those times. The decision is never again. Never again.
There's another appropriated phrase.
Correct. But when Draghi says whatever it takes, he's not lying. And the belief is whatever it takes to prevent those kind of deflationary shocks, those sort of liquidity systemic shocks from ever happening again. So there's been a political change, a political intention to change capital markets into what I like to call political utilities.
Oh, I love that quote. I actually put that at the top of my rundown. What started, I'm going to quote you here. I found it, I think maybe in one of your newsletters, or maybe it was in an interview you gave.
Yeah.
What started as an entirely laudable effort to keep capital markets from collapsing became an entirely problematic effort to turn capital markets into political utilities. I'd never heard anyone put it that way. What do you mean by that?
Well, you remember the movie Pulp Fiction?
Yeah.
Right. Yeah, one of my all-time
great
favorites.
Work of art.
Great work of art. And my favorite scene is when Uma Thurman ODs on, the heroin that John Travolta, gets her. She thinks it's coke and it's heroin and she ODs. And so they take her to, Eric Stoltz's house and they get that syringe of adrenaline. You remember?
Jesus Christ. Of course I remember.
Right,
it.
right,
I remember
right.
every scene in that movie.
And John Travolta takes that syringe of adrenaline and plunges it right into Uma Thurman's heart, right? That is what central banks did in March of 2009. And that is exactly what central banks are supposed to do. Yeah. The only job of a central bank is to provide emergency liquidity when, as you said, the beating heart of the global financial system stops beating. And that's what they did, right? But this is what happens, and this is what always happens, that emergency government action becomes permanent government policy. I'm not saying that's good. I'm not saying that's bad. I'm saying it is.
They never released the patient from the hospital.
You keep on now. It's not a one-time shot of adrenaline. You put them on an adrenaline drip.
Yeah.
Right?
Yeah.
And that's what, you hear today, that everything is framed and termed as stimulus. What stimulus is fiscal policy going to do next, right? What stimulus is monetary policy going to do next? Let's have more stimulus, right? This is not the language we had before 2007, 2008. And this is what I mean that
it's really that did not exist.
The language has changed, the intention has changed, the water in which we swim has changed to one where all of us as rational investors now expect and frankly live for the stimulus, the
Also,
spice.
Our sense of resilience has changed. The sense of fragility of our economy has changed. We can't seem to imagine living in a world without central bank intervention at this level.
And that's what happens with any addict.
And it was gradual too, right?
That's what
it didn't
happens with
happen
any
overnight. It was very gradual. It started with the Greenspan administration.
It has been gradual. It did start with Greenspan, right? The intentional pulling forward of economic activity so that we can be richer than our economy grows.
Indeed that, but also, I mean, the oracular quality, the fact that, remember the briefcase indicator? That obsession with the central bank, with the chairman, everything else. I mean, we don't have that level of centralization within the FOMC that you had under Greenspan, but the FOMC itself is more powerful in terms of guiding forward expectations with press announcements and statements and everything else.
That's so right. And again, it's entirely intentional. And this isn't a tinfoil hat thing. This is, Bernanke in his last public speech. It's interesting what people will tell you in their last speech, right? Whether it's Washington in his last speech or Eisenhower. I mean, when Dwight Eisenhower, for God's sake, tells you to watch out for the military-industrial complex, I mean, that's something, right? Mm-hmm. Well, Bernanke in his last speech as Fed chair said, it was a retrospective, and he's saying, well, it's been a long 8 years, frankly. We had the Great Recession, and we started off, we just had one toolkit, the toolkit of what do we do with short-term interest rates.
Also, another form of language, toolkit, that didn't exist before either.
This is correct, right? So he says, look, we took short-term rates down to zero. We didn't know at the time we could have negative rates. We took them down to zero. We thought we'd done everything we could. So what do we do next? He said, well, our next toolkit was, let's call it quantitative easing, but it's basically using our balance sheet to try to change behavior, right, market behavior. So it's what they call large-scale asset purchases, buying stuff, right? Changing the tenor or duration of the bonds that we buy. And so, but he said even that wasn't enough. So he says, look, I think QE1, I think that was really effective. I agree. I think QE1 saved the freaking world. That was that shot of adrenaline like in Pulp Fiction. But Bernanke's saying, look, QE2, QE3 we thought was a little counterproductive. And after that, we're not just pushing on a string. We thought we're not really doing much for the real economy. Agreed, right? But he said we still felt like we had to do something. So what do? We had a third toolkit. We call it communication policy. Call it forward guidance. There are multiple words used for it. It's not an accident that every week you have a couple of Fed governors who have, interviews on CNBC or the Journal or something. The schedule is planned, right? It is a centralized, determined activity. This is not an accident. It is the intentional use of words, not as an indication of what internal belief is, but the use of words to try to change other people's behavior. What we might call lying under other circumstances, right? And it doesn't mean that they're lies. It means that the words are carefully chosen and then carefully promulgated and distributed in order to achieve some sort of affect in investor behavior.
Do you know when the Fed first began to broadcast its targeted rate? Because it didn't always do that. That became policy later on.
No, it became policy under Bernanke. So Greenspan was famously in favor of intentional ambiguity.
But you always knew. You knew if the rate was 5%. In other words, what I'm saying is, even under Greenspan, markets knew what rate the Fed was targeting on any given day, right? Not forward guidance, but they knew that the rates were at 5%.
That's right. Forward guidance started with Bernanke.
But I'm saying that that wasn't always the case. It used open market operations to manage the interest rate, but it wasn't something that it would broadcast in the newspaper, what that rate it was targeting.
There's been an enormous body of work, and I think it's correct, which is saying that what really drives investor behavior is not whatever the interest rate is right now, but it's expectations, right? So what are our expectations for inflation in the future, deflation, what the Fed intends to do in the future? Markets happen on the margins, right? Markets are forward-looking entities, right? And it's the magic of them that makes it fun. What Bernanke started and Yellen really advanced, because Yellen was the one as vice chair who developed this committee on forward guidance and communication policy, is to try to remove that ambiguity, to try to say to markets, this is where we're going to be in the future. And it's like Frankenstein's monster, right? It really is a Frankenstein's monster. And this was Bernanke's point in his last speech. He said, in that last toolkit of giving forward guidance, we We didn't know how effective it would be. It was effective beyond our wildest dreams. And now we've created a monster, right? Because now we've created expectations that if we do something in the present that are at odds with those expectations, the market throws a temper tantrum.
They've created a maladaptive environment for risk-sensitive investors or anyone who can evaluate the merits of a particular
Demetri,
speculation.
they started this off to try to channel or push investor behavior in a certain direction. They are now prisoners, literally prisoners of their own words. Great point. Prisoners of their own words. It's amazing, right?
They have to keep going deeper and deeper. They got to keep digging.
That's right. They've created this prison. They've built it stone by stone, brick by brick, and now they are well and truly fucked.
And to keep that metaphor, to keep that hall of mirrors, they're in the hall. That's the problem for the Fed. The Fed has sold the markets and the media, or everyone's sold each other on this idea that the Fed is outside of the market. The Fed isn't outside of the market. The Fed isn't outside of the narratives that it spins. It is the largest player within those narratives, and its own actions impact them, which create the feedback, and they've lost the thread long ago.
So true story. When I first started writing Epsilon Theory in summer of 2013, I would go around to talk to masters of the universe, guys like Lee Cooperman or, Stanley Druckenmiller, right? So this is, call it 2014 going into 2015. I'd say, you know what? I got to tell you, the world has changed and the impact, and I think I can understand this through this, what I call the common knowledge game, the impact of words and narrative dominates market outcomes. And they didn't do this literally, but figuratively is like, pat me on the shoulder and, dear boy, no, you don't understand. It's a self-sustaining economic recovery in the United States. That's why the market is going up. It's a self-sustaining economic recovery. We have our indicators.
What does that technically mean, self-sustaining economic recovery?
It means that it's not words. It's not the Fed and their forward guidance. It's that
profit-driven.
That's right. That companies are selling more and doing all this. And over the course of the next so 2015, 16, 17, Druckenmiller, Cooperman, all these, again, masters of the universe, they just fall on their face, right? This is why these guys have shut down their funds and they're, converted to family offices. It's because everyone took their money away, right? It's because their models of fundamentals and how that drives market prices stopped working. Mm-hmm. So it was such an interesting transition that, exactly to your point, right, that the effectiveness of the Fed words and the like was actually much more powerful when people weren't convinced that, yes, the Fed is the end-all and the be-all for market outcomes. Today, no one believes in fundamentals anymore, right? Everyone believes that it is the Fed and monetary policy that determines market outcomes. That has become the water in which we swim, and that is what creates that prison for the Fed. It's a transformation that if you hadn't lived it a decade ago, you wouldn't believe the sort of transformation that's occurred.
So where are we today? Normally when I prepare for discussions, I have elaborate rundowns full of tons of material. I read a bunch of your stuff, a lot of your stuff. I watched a number of interviews, the ones I could find. So I researched, and I really couldn't come up with a game plan.
Right.
And I think I'm not sure exactly why that is, but part of it might just be because I wanted to kind of flow with it and see if we could kind of explore some of these narratives. But one of the things I've heard you talk about is the inflation versus deflation narrative, right? Yep. Where are we now with that? It seems to me that was the narrative up until 2012, and then it went away. I still don't know that it's back the way that it used to be. It used to be that kind of risk-on, risk-off environment.
Yep.
It was like, are we risk-on, are we risk-off, which is why I mentioned the volatility that we saw between 2008 and 2012.
So the great financial crisis of 2008 was a systemic deflationary shock. And deflation meaning a decline in prices. It was
brought on by the level of indebtedness.
Well, the epicenter of it was the deflationary shock in U.S. housing prices, right? A nationwide decline in housing prices, which had been levered, to your point, the indebtedness around the housing stock and then the securitization of that, so that we had a 10 trillion with a T dollar asset class in residential mortgage-backed securities.
The securitization created the conditions for the contagion.
Yes. What it created was not just I call it a solvency problem, right, where you had banks and other asset owners who had these assets on their books and said, oh, they're worth X, when really they were worth 1/2 X, right, in terms of the mortgage-backed securities. So the solvency, there was a real solvency issue for banks. But then what kills you is not the solvency, not being bankrupt, but illiquidity, when you can't fund it yourself, when the banks can't fund it themselves. And this is what we mean when I say the beating heart of global markets ceased. I mean that there was no bid for these assets, right? Yes, they had declined in value, but they had declined in value to a point where people didn't know what the value was, right? And many of these tranches of mortgage-backed securities had no value. They were worthless.
And these banks' risk models necessitated that those assets be worth what they said they were worth in order to maintain their other positions. It created a series of liquidations of collateral calls as necessities if they were to mark those to market.
That's right. It's a classic run on the bank, right? And it's a classic sense of, I don't know how deep the rot goes, so give me my fucking money and I'm out of here. Mm-hmm. And that's when first the U.S. Central Bank, the U.S. Federal Reserve, other central banks did the same thing. That is the job of central banks, to be that provider of last resort liquidity, to give that shot of adrenaline and say, we need money to purchase stuff. Say, here you go. Mm-hmm. Here's the money. And that's what the Fed did, right? And that's exactly the right thing to do. That's what a central bank is for, right? Coming out of that, though, and then we had I'll call it an aftershock in 2011, then 2012, centered in Europe, right? Which is, what about these sovereign debts here? We dealt with the mortgage-backed securities, which was centered in the United States in 2008. What about all that Portuguese and Spanish and Italian debt?
It's crazy how fucking powerful the financial lobby is. It's absolutely crazy. I'm sitting here listening to you talk, and I just can't help but keep thinking about it, because the way I see it, you want to talk about visuals, what I keep seeing is the financial system sucking all the money to the center and then redistributing it. It reminds me of a conversation I had with our guest from Hong Kong, Ho Fung Hung, where we talked about the power of the industrial lobby in China and how they managed to usurp the funds from the government. And this is what makes it difficult to transition to a consumer-led economy, because instead of giving the money to the people, they give the money to the industrial companies, which create subsidies on washer, dryer machines and cars and whatever else. You had the same thing with the banks. The banks always had to figure out, how can we manage these loans? It's not about let's free up the nation's debts, let's free up the debts of the consumers or the mortgage holders. It's always, how can we maintain the structure of the system? And so we've had these cycles of increasing levels of indebtedness, and we haven't solved the problem because of the concentration of power in the financial system. I kind of took us off a little bit there, but it was just what I was thinking about.
You didn't take us off at all. So I'll take us back to Adam Smith. Let's call it one of the founding fathers of capitalism. And he's not a laissez-faire guy, right? You read Adam Smith, The Wealth of Nations, all like that. He understands there's a real role for government, and not a government that's been captured by the entities that they seek to regulate. But there's a role for government to actively prevent any organization, any company from doing what companies do, right? Which is to try to cement and solidify their position. Now, I will tell you that what 2000 meant to me was I saw the thin veneer of democracy and the niceties of our system stripped away to reveal just the pure, naked sinews of power.
The curtain was pulled.
The curtain was pulled. That's exactly right, Demetri. And it was... And this will get us maybe into a conversation about Bitcoin, because I see the same actions of government that always happened in history, and certainly happened in 2008, where, again, who I call coyotes, smart people, they're trying to make a buck, and, they're too clever by half is what I call them. Like an institution like Bear Stearns, right? So Bear Stearns is taken out into the street and it's shot. It's a show trial. It's an execution.
Yeah, it was,
right?
it was a takeout.
It was a takeout.
At $2 a share.
Yeah. JP Morgan is given Bear Stearns the Bear Stearns building, which is now JP Morgan's headquarters, just a few blocks from where we're recording this. It's worth far more than what JP Morgan.
That reportedly went back. I mean, I wasn't obviously involved in this, but that reportedly went back all the way to the bailout of long-term capital management.
There are stories that go all the way back to that. It is fascinating, but it shows kind of the role of just personalities of people. But then, Lehman's taken out in a shot. Now, Lehman was engaged in, in my view, criminal behavior with what was called Repo 105, right? Where they are cooking the books at the end of every quarter to show less indebtedness so they look better on their statements than they actually were. I mean, I've written about it and, it's just unbelievable. But, I remember I'm sitting in my office as I managed my hedge fund. We had just short positions all over the place. I remember when Lehman went out and I had been able to take away all my direct counterparty responsibility with Lehman. I had what we called novated. I had moved that away from Lehman, a month or two before. So I had no counterparty exposure to Lehman, and all my positions, I was killing it the day that Lehman went out. And I remember sitting in my office thinking, this is great. And then I started getting calls, right, about Goldman, right, about JP Morgan and Morgan Stanley. And people calling me from, my friends at Lehman, said, I don't know what the fuck I'm going to do, but, I'm done here. And all of a sudden it hit me. It stopped being fun, right? Because I was making a ton of money. I was like, well, the whole system could go under here. The whole system could go under. And it turned when, not through TARP, right, but through a program called the Temporary Liquidity Guarantee Program. So the U.S. Treasury announced, this was about 3 weeks after Lehman went out, that if you were a U.S. chartered bank, a federally chartered bank, you would be allowed to issue senior unsecured debt with the full faith and credit of the United States government. Mm-hmm. Right. Within 2 days, both Goldman Sachs and Morgan Stanley registered as U.S. federally chartered banks. I think Goldman Sachs issued something like $40 billion in senior unsecured debt with the full faith and credit of the United States. So it makes me angry, literally angry, when, Lloyd Blankfein or, one of these guys says, oh, you never took a bailout and, we didn't want TARP. And you're right, you didn't want TARP. But that TLGP program, it saved those banks. And it was a co-opting of those banks. That and the paying off AIG, counterparty obligations at 100 cents on the dollar.
My God. That story was totally miscovered. We had Matt Taibbi on the program, and we talked about that because he made the great point that no one was talking about it. No one was explaining how AIG was basically a money funnel for these investment banks that had insurance products on the other end, which also they got bailed out both on the insurance and on the bonds.
Correct.
It was a massive heist.
100 cents on the dollar.
Massive heist. And the media was either too understandably ignorant to cover it, or they were totally, in bed with the companies they were covering because their sponsors and advertisers were those same companies. You had a few people that covered it after the crisis happened, like Radigan at MSNBC.
Right.
But, eventually he left and went went off to a farm or whatever. But, this thing you mentioned, Bitcoin, and I agree, and I'd love to know how you're going to tie it in there.
Yeah.
Because I think what this time did, it created a profound sense of disillusionment for a large part of the country, but in particular, specifically, all the people that got screwed, not just on that crisis, but on the previous one. And we've created such a disenfranchised class of people. And that is particularly true for millennials and younger generations, right? And this brings to Bitcoin, who have now basically, they see our financial system and our political system as a scam. They know they'll never get rich playing by the rules. If they're lucky, they might get into the upper middle class. They're carrying tremendous amounts of student loans. Real estate prices are through the roof. They can't get a return worth a dime on their savings. And so what do they say? F the system. We're going to do an end run around by buying Bitcoin, all right? Or the crypto revolution, so much of that has to do with a profound sense of disillusionment, and it's a rational decision to say, well, there's no way I'm going to get ahead playing by the rules. There's no way ahead I'm going to hold shitcoin fiat US dollars, and so what am I going to do? I'm going to buy Bitcoin, and we're all going to hodl together and we're going to try to extract this wealth back for our generation.
So this movie has been played before, right? And I think the best way to describe it is you, and by you, I'm not talking about you, Demetri, I'm talking about that community that you're describing, right? The disillusioned.
I've been disillusioned. I mean, I went into the financial crisis.
Yeah.
Could I have foreseen every single knock-on effect? No, but I was certainly well-positioned to take advantage of it. I understood the dynamics of the mortgage market. It was not a surprise to me at all, and there was a part of me that was finally grateful for its arrival. Because I had been waiting and waiting for it, and I felt so stupid having all those stupid cocktail conversations where I'm saying, yeah, we're going to have a crisis, everything else. I was like, gosh, you're a Chicken Little. And then when it came to see, just like you said, to see the curtain pulled back, to see Henry Paulson and Ben Bernanke and Tim Geithner, and then the new president of the United States, all these people, just basically saying, okay, we lost control. We're just going to stop the game here for a second, and we're going to reach over here. We're going to take that from you,
take it back.
And you're not going to say a word. Because remember, we have the military, we have the power, we have the laws. We're the government. Yeah. All right? And then we'll reset the whole table, and then you can start over again. All right?
You know what they have in addition to all that you described? They have the story. They have the narrative. Right? And that's
which they've lost control of.
See, I'll disagree with you on that. One of the amazing things about, I'll say, the disintermediation that the internet provides, right, is it allows someone like me, right, to start writing a freaking blog and now have 100,000 people who are, reading my stuff, right? And there was no intermediary there. There was no arbiter. There was no publisher. It's purely word of mouth and that there's magic in that. Or you with this podcast,
sure,
right? And the reach that you have now. At the same time, the ability and the understanding of what I like to call the nudging oligarchy, the nudging state, right? Because it's not done with a jackboot. It's not done by sitting in the stormtroopers, right? It's done exactly the way that the Federal Reserve has changed financial markets over the last 8 years, which is to use their words.
The manufacture of consent.
The manufacturer, right? The whole Noam Chomsky idea, right? And you don't have to have that same sort of, I'll call it, conspiratorial, bizarro sense that Chomsky has, right? So Chomsky's a weird freaking dude, right? But there's more than a germ of truth to it, right? You don't have to have the belief in the smoke-filled backroom conspiracy of it to understand this is the way it has evolved.
Well, I don't know that he had a smoke-filled room view of it. I think it's interesting. That's your interpretation. Yeah. I felt that he had, I think his politics are extreme. And I think they're unworkable for people like you and me.
But I'm praising his notion.
Sure.
What you just said, the manufacture of consent, is really spot on.
Right.
So what I'm saying is that the ability to control that narrative, to present it, not just when, Mnuchin says something like, terrorists are using Bitcoin, right? And I'm thinking more about what's coming down the pike in terms of, I wrote this note about Libra and the Facebook coin. The other, I'll call it not censorship-resistant coins or projects that are coming out, but the censorship-embracing coins that are coming out, right? Like Libra.
Mm-hmm. You think they're embracing Libra?
No. I think that Libra I'll call it as a technology, is not censorship-resistant. It is censorship-embracing, right? But the whole notion of Libra is to play ball, right, with the government. Now, whether there's too much baggage associated with Facebook, and as much as they try to disengage Facebook from, the Libra consortium and the like, we'll see how it plays out. Everyone's thinking right now that, Libra is DOA and it can't work. Let's just say, let's give it some time, because I think this whole project has legs, and I think it will actually work. And if it's not Libra...
You think Libra will work? You think it has legs?
I do.
Why?
Because it is so attractive as a co-opting mechanism for government, right? It is so attractive for people to say, I'm doing good. And in a sense they are, right, by banking the unbanked or doing cross-border transactions or the like. There's a skin to Libra that I think is laudable, but it's just a skin. It's why I described it as the Spanish prisoner con, right, which is the oldest con game in the book.
But, talking about narratives, Ben, Silicon Valley has lost the narrative. Silicon Valley has lost the narrative of being the good guys that they were before 2008 and during 2008. They're now the bad guys. And Facebook is the number one bad guy. So I agree with you with this. I sort of mechanistically agree with this idea that you can have this potential for co-option and that the government can sort of reprimand Facebook and then bring them into the fold. Mm-hmm. But I think that Facebook has just got, the narrative is shifted on that company and on the market generally.
Demetri, I hope to God you're right. I hope to God you're right. I will say, though, that in a adult career, a professional career of 30 years of working with narratives, I never want to count out, again, what I call the oligarchy or the state, right? Because their wheels grind slowly, but they grind exceptionally well. And it's almost impossible to kill. Almost impossible to kill. It's easy to kill.
What?
The state or the oligarchy.
Oh, well, I agree with that,
right?
But I'm just saying that this particular iteration, this company, this project.
I hope you're right.
But your larger point, I agree with.
But if it's not Libra, it's going to be another version of essentially censorship embracing e-cash, right? Because what the state wants is to not just get rid of a censorship resistant coin like Bitcoin, but to get rid of paper cash, right? Because that's also censorship resistant, right? The paper that's been printed. What they want and what they're getting, because there's both a carrot and a stick, and both these carrot and the stick are both narrative based, is to eliminate or to drive, greater and greater control over transactions and currency. I mean, that's the existential issue for the state.
Control over the currency. I agree with that.
Correct.
Right.
Correct. So
there's no way they're going to give up control.
Right. So the carrot and the stick are both what I call narrative based. So what I see with Libra and the other, I'll call it, again, censorship embracing coins that are coming down the pike, that's the carrot, right? It's like, oh, you can do good. You can have all these conveniences. This will be just so much easier. It's why e-cash is used, in Europe so much, right? I mean, it's...
When you say censorship resistant,
yes,
what do you mean? Would you say that today we have censorship embracing system right now? What do you mean by that?
So to me, the great attribute of a Bitcoin is, again, censorship resistance. So that it is, in a very important sense, inviolable, right?
You mean the ledger is immutable?
Correct. The ledger is immutable, and...
You mean it in the sense of it is a permissionless database. Granted, it has its points of centralization in mining power, et cetera, but that it is theoretically a permissionless database.
It is that immutability, right? It is that truth that you are, in a sense, invisible.
Not really, though.
Well,
because there are companies that have done a lot of work in this area to unmask accounts.
Look, I understand that. And that's the difference between the accounts and the ownership and that intersection with an exchange, right? Where the intersection with the real world is where this...
It's kind of like 23andMe.
breaks down. Yeah, yes. Yeah, yeah, right.
You don't need to have everyone giving up their genetic code to figure it out.
But the difference between that and a censorship embracing system is that Libra is designed to allow, right, and to encourage government monitoring of transactions, right?
Right.
It's
but that is different than immutability.
Yes, it's different from immutability, right? So what I'm saying is trying to
what
draw
I mean
the
is you can have
distinction.
immutability and still have like KYC, AML, all that stuff. One is not mutually exclusive of the other.
With you 1,000%. With you 1,000%. Immutability is part of what I mean by censorship resistant, but it's not really the defining characteristic of censorship resistance, right? The ability not just to, like I say, to hypothetically track at like the account or the exchange level, but to actually monitor the transactions from start to finish, essentially to get a wiretap, and the equivalent of a wiretap for voice communications is what is possible, for example, with Libra, and that's intentional.
Right,
it's intentional. There's nothing designed there to maintain privacy of transactions or of ownership.
Right. I mean, I don't know enough about the sort of initial concessions of Libra. I mean, yeah, I guess so, because they're allowing for full regulatory oversight. But, I mean, is it even desirable not to have that today, given the issues of cybersecurity and the power afforded to individuals to conduct acts of terror in a digital world? And in a world where you could 3D print a virus, let's say, at some point.
So my beef, if you will, with Bitcoin is that I believe, and I believe this strongly, that engaging in the business of money, of creating money, puts you at such existential odds with the state that it is an absolutely untenable position, right? So I am confident beyond words that whether it's Libra or some version of this, that is the version that will, through both carrot and stick, will get widespread adoption and will become the water in which we swim. And it relegates Bitcoin then to essentially the role of gold today. Right?
Yeah.
And that is a role which befalls people say, oh, that's great. We're a store of value, right? That's what I mean by you're being assigned a role. It's like you're invited in by, a producer of a place says, I want you to read for this role. And you say, oh, great. I'll be on stage. I'll do this. No, this is a miserable role, right?
Why? But for owners of Bitcoin, it could mean higher prices. The narrative in the Bitcoin community has consciously shifted to what you're describing right there. And the focus has not become, this is no longer a medium of exchange.
It's a store of value.
It's a store of value. Right. And what matters is that there's a constrained supply schedule, and they've fallen back on, ironically, the very core libertarian. They've moved away from the cypherpunk stuff more and moved more over to the libertarian, Austrian economic, hard money stuff.
And this is what I'm saying. This is a miserable way to live. It's a miserable way to live. It really is, right? Can you make money with it? Sure, you can trade it, right? Knock yourself out, right?
Well, what do you mean it's a miserable way to live? You mean it's a miserable story?
No, what I mean is that you are now taking on the role that gold owners, true believers have had for the last 50 years.
Exactly.
And
that's exactly correct.
It's a role where you find yourself now essentially hoping for economic collapse. Because now you'll be proved right.
I understand what you mean.
I'll be sitting pretty when the world comes to, conflagration.
Yeah,
right?
It's a bet against the system. Well, in fact, that's what Bitcoin is. It's a hedge against systemic risk.
Well, but to what you just described, it wasn't always that way.
No, it wasn't.
It wasn't always that way. No. But the story's now changed around Bitcoin. And what I'm telling you is you are being, the Bitcoin community is being led down this path, right? And the carrot is, it's going to be worth something. Right? It's going to be like digital gold, which I agree. It's like digital gold, but you're being balkanized. It is the true and original meaning of a ghetto, right? Where you're having this neighborhood constructed for you. Oh, look how nice this is. You're going to live over here now. And say, thank you very much for constructing this neighborhood. And then you move in and you think, well, now I'm here. I'm the grumpy old man who yells at clouds now. And it's pervaded with, again, this negative energy. And it's so different from, I think, where so many people started their involvement with Bitcoin or crypto more generally, that you're trying to change the world in a positive direction.
This is an interesting conversation. And it's great to compare the work done on the communication protocols of the internet in the 60s, 70s, and 80s to what's happening now, because that was very different. That was government funded. There was no financial incentive to have your particular base layer protocol win out. And so you've got this perverse financial speculative layer in cryptocurrencies that didn't exist for the communication protocols. And so it diminishes the power of the aspirational technologists relative to those who are looking to get rich. There's nothing wrong with looking to get rich. And like I said, to bring us back to one of the things I said early on, there's been a profound disillusionment among this generation. And so for many of them, not only is this the rational decision, but for many it feels very much morally justified. Hey, you guys screwed us. You screwed us big time. You went to college and you could work a part-time job and pay for your college? What world are you living in? My tuition is $200,000 for 4 years. I've got student debt out the ass. I can't afford a house. I can't even afford to make rent. I got to move out of the city. Yep. You know what I'm saying? So I understand that, but I think we've touched on so many interesting dynamics, narrative dynamics here, and sociological phenomena. And I think actually what's one of the most interesting things to study in the Bitcoin community would be the anthropological, sociological, cultural dimensions of it. But you have this this tension between the economics, the speculative component, and those who genuinely are in it and have been in it from the beginning for the technology. And the technology of Bitcoin has profound limitations. It has profound scaling limitations. And this, I think, is the underlying substantive reason for why this narrative has had to shift.
Mm-hmm. So I'm struck, and this has been my personal, I'll call it evolution around Bitcoin. I don't change a word I've written about the role of Bitcoin and its balkanization or ghettoization in terms of narrative and in its place in the financial system. Where I have changed is recognizing a lot of what you're describing about the community, right? And those anthropological issues, which sounds too, again, scientificized, too cold to call them anthropological. There's, again, I don't have a better phrase for it, a positive energy associated with the Bitcoin community, a desire to do good. It's mixed, though, with, and this is always the case with, people I like to call coyotes, right? Mixed with a desire to, make some money, right? To do well by doing good. That's the majority.
The majority. That's the vast majority.
And
well, when
Lambo. Right.
That's not coincidental.
Right. Yeah. No.
Right? And by the way, I'll just throw another thing out here, Ben. This is really interesting, and I got to credit someone I was speaking to yesterday who helped me with this realization. When I was growing up,
mm-hmm.
hip hop was coming on the scene,
mm-hmm.
or it was already on the scene. I grew up with like Biggie, Tupac, Snoop Dogg, and hip hop was cool, but it wasn't mainstream culture. A lot of that, and also a larger culture of emphasis on wealth. Specifically, I frame it in terms of hip hop because I think a lot of that has to do with the mainstreamization of hip hop music and hip hop culture, which is so focused on wealth and the displays of wealth. But also, just generally speaking, our society has become much more focused, it seems, today than in the past, that I remember, on money as being the metric of success. And I think that has also driven so much of this. So you have a generation that is more focused on wealth than they were in the past, let's say my generation growing up, and yet they have less access to it. And I think that's another fascinating thing. And if I'm wrong about the hip hop thing or generally about this, I might be. I'm coming at it from a bit of the outside, but that is my view.
So it's so striking to me, and this jives with what you're saying, it's so striking to me that when I have conversations with people and I say, look, what I want to do is I want to separate the positive energy and the technological aspirations from the creation of money, right? That it is possible to separate the two, that there are so many aspects of identity and autonomy and self-sovereignty and independence and liberty that can be advanced through the technology that have nothing to do with money. And the reaction is, well, how are you going to incentivize people to do this work, right? Unless you're, paying them, as miners, they can create the coin and they can make money through it. And my answer is, there are so many things that motivate humans, right? And so I think about, I'm not a religious guy, but I think about, I'll call it a civic religion. I think about the politics, civic religion, these issues which do motivate us to spend our money. I'm all for making money. What I'm saying is that when you're trying to make a living, when you're trying to create wealth by making money, you are setting yourself up for a fight you're not going to win. Right? You can trade it, you can do the like, but if your goal is to, this is how I'm going to route around the state, and this is how I'm going to undo the pernicious control of, big government and big business, I promise you're setting yourself up for a fall. And there's another way. There's another path, right? It's tough love. It's hard to say, right? Because you want to be able to say, you can do well by doing good, right? But the truth is that doing well and doing good need to be separated. And I hear you when I say that I don't know what there is to be done about the disillusionment and the feeling, and it is a palpable feeling that you've been cut out from the wealth and the goodies that the boomers have accumulated, right? But I don't think there is something to be done about it, and you've got to come to grips with that.
I'd like to talk about that, and I'm going to set the table now because I want to move us into overtime. I want to say it's ironic that these permissionless databases, these distributed ledgers, cryptocurrencies, their economic model, which you're talking about here, is private funded. Mm-hmm. It's based primarily on speculation. It's not really the miners. It's people's willingness to plow into these
Yep.
cryptocurrencies, it's born in part out of a loss of faith in government, not just a loss of faith in government on the monetary front, which caused the demand for the currencies,
Right.
but a loss of faith in government that the model of the government funding academic institutions to do the research, let's say to build the second layer, trust layer protocols, right? This is a profound change. We've covered this on an episode with Bill Janeway, not specifically this, but the innovation economy and the close role that the government had played during some important phases in the innovation cycle. Mm-hmm. And that's something that has been lost with a lot of these ideological divisions that have been exacerbated by political tensions caused in part by the inequality, mm-hmm. right? So I want to get into that. And I want to move us into the overtime, Ben, where I want to explore some of the major, I think, narratives that have come up. Some of them will be economic, but I think some of them, one of the very powerful ones that emerged in the last decade has been this rise of white supremacy.
Okay.
And there's also the change of China, right? China used to be considered an exemplar partner in the global order. Then they moved to a frenemy kind of in the first decade of 2000s. And now we're sort of in outright conflict. We're seeing them as enemies. Privacy versus security, isolationism as America versus the indispensable nation, things like this. Ben, I want to thank you for coming on. For our regular listeners, could you tell them how they can read about Epsilon Theory and follow you?
Oh, thank you. So it's epsilontheory.com. Epsilon Theory, it's a financial jargon really, where we talk about alpha, beta, and epsilon is considered the error term. And the point of what we try to do, to look at finance and politics through the lenses of game theory and history, is say, well, there's so much that's not covered in, again, this over-scientificization of assigning things to alpha and beta, that behavior, particularly strategic interaction and the use of narrative, it's not error, right? But it's there in that epsilon term. So the name of the blog is epsilontheory.com. And, it's free to read, and we'd love to have you check it out.
Well, I've, as I said, I spent the weekend reading your stuff, Ben, and it's really great. The only other person I can think of that does similar work is Robert Prechter. Mm-hmm. I'm sure there may be others, but Prechter is the only person with his Socioeconomic Institute that I've come across who tries to figure out what sort of the social narrative forces are that might be driving markets. His is much more sort of numerological.
Yes.
But it's interesting. It's quite an endeavor. And I do highly recommend that listeners listen to it. On that note, for anyone who's interested in listening to the overtime to this episode, Ben and I are going to stay on and continue our conversation. You can do so by heading over to patreon.com/hidden forces and subscribing and supporting the show. There's no long-term commitment. You can cancel at any time. And I've often said this, and it's true. The overtime is oftentimes better than the full episode. And you can also gain access to transcripts and rundowns. Ben, thank you so much.
My pleasure.
Today's episode of Hidden Forces was recorded at Creative Media Design Studio in New York City. For more information about this week's episode, or if you want easy access to related programming, visit our website at hiddenforces.io and subscribe to our free email list. If you want access to overtime segments, episode transcripts, and show rundowns full of links and detailed information related to each and every episode, check out our premium subscription, available through the Hidden Forces website or through our Patreon page at patreon.com/Hidden Forces. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforces.io. Join the conversation at Facebook, Twitter, and Instagram at Hidden Forces Pod, or send me an email at dk@hiddenforces.io. As always, thanks for listening. We'll see you next week.